In the space of one trading session, gold fell to about $5,164 an ounce from nearly $5,600, and silver dropped to roughly $109 after flirting with levels that sounded like a misprint. Not months, not weeks, in a blink. And yet, it happened anyway, right in front of everyone, while the headlines tried to explain it as a normal pullback. Here's the uncomfortable part. That snap lower didn't arrive out of nowhere. It arrived on schedule. Institutions had already seen the setup forming, not in the price candle, but in the machinery that controls how price is allowed to behave. When the machinery shifts, price follows. When the machinery shifts fast, price doesn't glide. It lurches. And the biggest clue wasn't a rumor or a viral thread. It was a rule change. On December 29th, 2025, silver suffered an 11% intraday drop on COMEX after the CME raised margin requirements on the March 2026 silver contract. Initial margin moved from $22,000 to about $25,000. That OAS, roughly a 14% increase in the cash traders must post to hold the same exposure. In plain language, the exchange turned the leverage knob down at the exact moment the market was leaning on leverage. They said this could never happen. They said metals markets were too mature for disorderly cascades. They said physical demand would buffer any shock. But what happens when the shock is not about demand at all, and instead about who can stay in the trade? Let me show you what the data actually says, because the data is where the playbook becomes visible. Welcome to Signal Ledger, where we decode what matters before it becomes a headline everyone repeats. If you like calm analysis that connects filings, flows, and history into one coherent picture, consider subscribing the way you or D keep listening to that wise elder who always seems to know what S coming. And as you listen, drop a comment telling me where you're watching from, because the macro map looks different depending on what you can feel in your own economy. Now, the central mystery is not that gold and silver can fall. Everything can fall. The mystery is why the market had to fall like that, in bursts and air pockets and moments where bids vanish and price gaps as if the floor was removed. Start with the forensic timeline. Silver runs hard into late December. Momentum builds, leverage builds, and everyone assumes the tape will keep rewarding the same positioning. Then, margin requirements increase. This is not a moral judgment. It is a mechanical event. Margins are the toll booths of futures markets. Raise the toll, and some drivers must turn around immediately, whether they like the destination or not. When margins rise, leveraged holders face a choice. Add cash, cut position, or get cut by force. Many choose to cut because adding cash in a panic is expensive, and liquid cash is scarce exactly. When volatility spikes. As positions are cut, price falls. As price falls, more holders breach risk limits and more selling is triggered. That is the cascade. It is not psychology first. It is plumbing first. Then the next layer hits. Gold, which often moves with a slower dignity, reacts to the same tightening of financial conditions. 4% to around 5,164 after being near 5,600. Silver is down more than 5% to around 109. Those are extreme moves. For markets that are often described as stores of value. The store is still there, but the checkout line is being controlled. Here's where it gets interesting. While Western paper markets were being cooled with margin hikes and forced deleveraging, China was moving in the opposite direction in the physical and policy sphere. Starting January 1st, 2026, China tightened controls on silver exports. Not because silver is fashionable, because silver is strategic. It drew 9 million ounces after October 2025, extending a buying streak. And globally, central banks bought 220 tons of gold in the third quarter of 2025, a 28% jump from the prior quarter. Those are not memes, those are institutional footprints. So you have a market doing two contradictory things at once. On the screen, prices can be slammed by leverage mechanics. Off the screen, policy and official accumulation keep tightening the real-world supply and reinforcing the long-term bid. That contradiction is not a mystery, it is the playbook. To understand why this is operational now, you have to recognize the pattern because it has happened before and the sequence is eerily consistent. In 1980, silver didn't just rise, it erupted. And when it did, the response wasn't a polite request to calm down. The response was rule changes, margin hikes, and a sudden shift in the conditions for participation. The result was a violent reversal that punished leverage and rewarded those who understood the structure rather than the story. In 2011, silver ran again, fueled by momentum, inflation fears, and a sense that the paper promises were finally being exposed. Then came margin increases, repeatedly in short succession. The result was a rapid drawdown that looked like the market changing its mind, but was more accurately the market changing its financing. In 2025 into 2026, it's happening again. You see a surge, you see leverage, you see a tightening of the toll booths, and you see the cascade. The pattern is not that metals always crash after they rise. The pattern is that when leverage becomes the dominant fuel, the exchange becomes the dominant brake. This is not opinion. This is pattern. Now let's name the players, because the story isn't told by the market as a monolith. The story is told by specific institutions with specific levers. First, the exchange complex. The CME sets margin requirements for COMEX futures. When it raises initial margin from 22,000 to around 25,000 on a major silver contract, it is not predicting price direction. It is responding to volatility and risk. But the effect is directional in the short term because it forces position reduction from the most leveraged participants. Second, the clearing members and banks that provide financing and risk lines. When volatility spikes, risk managers tighten. Credit lines shrink. Haircuts rise. Collateral demands increase. This amplifies what the exchange begins. A margin hike is the match. Risk tightening is the dry grass. Third, the state actors. China's policy apparatus matters because China is not just a consumer. It is a coordinator of industrial inputs, a manager of export flows, and a holder of official reserves. When export controls tighten on silver starting January 1st, 2026, it signals a priority shift. And when the PBOC continues to report higher gold reserves into late 2025, it signals a preference shift. It is a message in ounces. Fourth, global central banks. When they buy 220 tons in a single quarter, up 28% from the quarter before, they're not chasing a trend for entertainment. They're adjusting reserve composition, hedging currency risk, and preparing for a world where trust in paper claims is more fragile. Fifth, the industrial complex. Silver is not only money metal theater, it is input metal reality. Solar, electronics, chemical catalysts, medical applications, and more. 6% year over year, that's a sign of rising throughput and strategic inventory management. 7%, 6%, those are flows that matter. And here's the coordination no one needs to conspire about. Timing creates coordination without a meeting. When policy tightens on physical export at the turn of the year and margins tighten on paper exposure at the end of the year, the effect is the same. It channels who can access metal, who can access price exposure, and who means it. This is the part no one is discussing. The market is being split into layers. Layer 1 is paper price, which can be pushed around by leverage and rule changes. Layer 2 is physical availability, which is constrained by policy, logistics, and strategic stockpiling. Layer 3 is official behavior, which sets the long-term floor by steadily removing supply from the global float. When those layers diverge, you get dislocation. Dislocation is when two markets tell opposite stories. Now, dislocation doesn't mean price immediately explodes. It means pressure is building. It means the elasticity of the system is being tested. It means the gap cannot persist indefinitely without something giving way. Let's quantify the dislocation in a way that's easy to visualize. Imagine a warehouse of water. Paper claims are water coupons. Physical metal is water in the tanks. In a calm world, coupons and tanks match. But when coupons become too abundant or when tanks are quietly being drained, you can keep the illusion going only as long as people accept the coupons without demanding water. Margin hikes are like raising the fee to hold coupons. Some coupon holders must sell their coupons because the fee is higher. The coupon price falls. Observers conclude the water is less valuable. Meanwhile, export controls are like locking the warehouse gates. Water is still valuable, but fewer people can access it. The tank level becomes more relevant than the coupon price. This is where the paper price can look weak while physical conditions tighten. That gap is the signal. Now let me show you the evidence with numbers, because narrative without numbers is just theater. 6% year over year. 6%? 7%? Those aren't tiny changes. That is a system moving more silver through more channels, faster and at higher values. 0.9 million ounces. After October 2025, that matters because gold reserves are not a casual portfolio. They are a strategic asset on a national balance sheet. And zoom out globally. Central bank gold purchases of 228 tons in Q3 2025, 28% higher than the previous quarter, represent institutional demand that is price insensitive compared to retail. Central banks don't buy because of a chart pattern. They buy because of a regime shift. Now connect those to the paper market shock. The CME margin hike on silver, moving initial margin from 22,000 to about 25,000 on March 2026 contracts, didn't change the physics of silver. It changed the ability to finance silver exposure through futures. So what does it mean when financing is tightened on paper exposure at the same time physical control is tightened on real supply flows? Historically, it means a transition from a single price regime to a two-speed price regime. In the early stage, paper volatility dominates and shakes out weak hands. In the later stage, physical tightness reasserts itself, often through premiums, delivery stress, or sudden repricing when the market realizes the real supply is smaller than the paper crowd assumed. This is not a prediction. It is what the mechanism has produced repeatedly when policy and leverage collide. Let's break down the mechanism, step by step, without jargon. Step 1, a rally attracts leverage positioning, not because people are reckless, but because leverage is how many participants participate at all. Futures are built for leverage. That's the design. Step 2, volatility rises as the trade becomes crowded. Volatility increases risk for the exchange and clearing members. Step 3, margins rise. This is a risk control response, but it has a market impact. Higher margins require more cash to maintain the same position. Step 4, cash is finite. Some traders add cash, many reduce exposure. That reduction is selling pressure. Step 5, selling pressure pushes price down. Price down increases volatility. Volatility invites more margin pressure, more risk tightening, and more forced selling. Step 6, the paper market resets lower and cleaner. Leverage is reduced. Open interest may fall. Step 7, physical demand doesn't vanish just because paper price fell. Industrial users still need metal. State actors still pursue strategic stockpiles. Central banks still pursue reserve shifts. Step 8, the dislocation widens. You see weakness on the screen while the real-world bid strengthens quietly. Step 9, eventually the system has to reconcile. Either physical loosens or paper reprices, or the market develops persistent premiums that reflect the difference between owning a claim and owning metal. That reconciliation is where the biggest misunderstandings happen, because most people focus on price, not structure. Now, how does China's gold plus silver playbook fit into this? Gold is the reserve pivot, silver is the industrial choke point, gold is the balance sheet message, silver is the supply chain message. Year 9 million ounces. It signals a preference for assets outside another nation's liability. When China tightens controls on silver exports starting January 1st, 2026, it signals that silver is being treated as a strategic input with national priority. Put those together, and you have a playbook that is not about trading. It's about sovereignty over inputs and reserves. And when that playbook goes operational, you see two things. You see stress in Western paper markets because paper is where leverage lives, and you see control in Eastern physical policy because physical is where industry lives. Now, let's address the expert contradictions because they're part of why this matters. Some analysts will point to falling prices and say demand is collapsing. Others will point to central bank buying and say demand is unstoppable. Both can be true depending on which layer you're watching. Paper demand is demand for exposure. Physical demand is demand for material. Official demand is demand for strategic insurance. Those are not interchangeable. A margin hike can crush demand for exposure overnight. An export control can constrain material flow overnight. Central banks can keep buying through both because their objective is not the same as a trader's objective. So when you hear contradictory takes, don't assume someone is lying. Assume they're looking at different layers. Here's where it gets even more revealing. The so-called catastrophic move is often the opening act, not the finale, because it cleans the stage. It removes excess leverage. It makes the next move possible, whether that next move is further downside, sideways rebuilding, or a fresh advance driven by different forces. If leverage was the fuel, the fire is extinguished by margin. If policy and physical are the fuel, the fire doesn't go out. It smolders until the conditions align again. So what should be watched going forward if this playbook is operational? Watch the rules before you watch the price. If margins rise again, it signals that volatility and leverage are still dominating. If margins stabilize or fall, it signals that the exchange believes risk is receding. Watch signs of physical tightness, not just spot quotes. That can show up as unusual premiums, delivery bottlenecks, or persistent divergence between different regions' pricing. Watch official reporting and central bank behavior. When central bank buying remains strong, it signals that the highest level of institutional capital is still choosing metal as a reserve hedge. Watch policy shifts on export and import controls. When a country tightens or loosens restrictions on strategic metals, it changes global availability more than any daily candle. And watch the relationship between gold and silver, not just their absolute prices. When silver behaves more violently than gold, it often signals leverage and industrial sensitivity colliding. When gold remains firm while silver is chaotic, it often signals reserve demand is steady while speculative positioning in silver is being cleaned out. Now let's map the forward scenarios in a way that respects uncertainty. In a conservative scenario, margins remain elevated, volatility cools, and prices grind while physical policies keep tightening in the background. The screen looks boring, but the structural tension increases. In a moderate scenario, the paper market finishes its deleveraging, and then the physical and official bid reasserts itself, leading to a repricing that looks sudden to those who only watch the decline. In an aggressive scenario, dislocation becomes visible through persistent regional premiums or delivery stress, forcing participants to reevaluate the difference between owning a promise and owning metal. Historically, when that happens, repricing can be sharp, not because of hype, but because the market is catching up to constraints that were already there. Notice what's absent: There's no guarantee. There's only structure, pressure, and history. And that brings us to the divide. The divide isn't between people who are smart and people who aren't. It's between people who track price and people who track the machinery underneath price. Price-only watchers are always late to regime shifts. They react to the candle. They accept the headline explanation. Structure watchers see the story earlier. They see margins change. They see policies shift. They see central banks accumulate. They see trade flows rise. They recognize that institutions move first because institutions operate on incentives that require early action. The information gap becomes a wealth gap, not because of intelligence, but because of attention. Institutions get the memo in the form of rules and flows. Retail gets the memo in the form of a chart after the move is done. So the question isn't whether gold and silver can be volatile. You just saw they can. The question is whether the system is shifting toward a world where physical control and official accumulation matter more than paper narratives. Because if that continues, historically, the market doesn't reward the loudest opinion. It rewards the clearest reading of the machinery. This is signal ledger, where we decode what matters before it becomes headlines. If this connected dots you hadn't seen, if it made the chaos feel mechanical instead of mysterious, you know what to do. And remember, the question isn't whether the playbook unfolds. The question is whether you recognized it while it was going operational. One more lens makes the current sequence click. Financing shocks often masquerade as fundamental reversals. In 2008, markets learned that liquidity can vanish faster than confidence. And when it does, prices are set by whoever must sell, not by whoever wants to buy. A similar flash appeared in March 2020, when even gold dipped briefly because cash was the only instrument that could meet obligations in real time. That distinction matters now. A sharp drop can be a liquidation event first, and only later does the market get a chance to vote on what the asset is worth when financing pressure eases. Silver is especially sensitive to liquidation because it straddles two worlds. It behaves like a monetary metal when fear rises, and like an industrial input when factories and supply chains matter more than sentiment. That dual identity is why margin hikes hit it so hard. A margin hike does not debate the long-term narrative. It changes who can afford to stay in the trade today, and it forces the most leveraged exposure to shrink immediately, regardless of conviction. Now, zoom out to the East versus West split. Western price discovery is dominated by paper venues, where a contract can be created, traded, and closed without anyone touching metal. Eastern policy, by contrast, focuses on securing physical flow because factories cannot run on promises. When a state tightens export controls, it changes the availability of real material even if the screen price is falling. That is how dislocation grows. Paper exposure becomes cheaper and easier to trade, while physical availability becomes more controlled and more valuable to those who actually need it. Export controls also shift bargaining power. If less metal is allowed to leave, more of the world must compete for what remains outside the gate. The first signs do not arrive as a dramatic headline. They arrive as procurement teams paying up for certainty, longer lead times, and a preference for trusted suppliers. Spot quotes can lag those realities during a paper liquidation because the futures market is busy unwinding leverage rather than reflecting scarcity. Operational means something simple. Rules changed, financing tightened, physical policy tightened, official accumulation persisted. The system is being nudged into a regime where collateral and control matter more than commentary. The chaos on the screen is not random. It is the sound of the market adapting to tighter constraints, one margin call and one policy decision at a time. The key is that the market can look weaker precisely when the incentive to secure metal is rising. When paper selling is forced, it can create bargain headlines and fear headlines at the same time. But underneath, the constraint is tightening, and that tension tends to reappear later as surprise.